When it comes to life insurance, most Canadians end up in one of two camps. They either buy too little coverage and leave their family exposed if something happens, or they buy way too much coverage and spend money every month on protection they don't actually need. Here's the reality. Figuring out how much life insurance you need is not guesswork. It doesn't come down to what the bank offers you or what number feels right. There's a simple formula you can use to calculate the exact amount of coverage that makes sense for your family. And once you know your number, you'll feel confident that you're protected without overspending. Hi, if you're new here, my name is Elizabeth from Boss Budget Labs, and I help Canadians, business owners, professionals, and families protect their wealth and build strategies that last for generations. In this video, I'm going to walk you through a step-by-step process to calculate exactly how much life insurance you need. By the end, you'll be able to apply this formula to your own situation and avoid the costly mistake of being underinsured or overinsured. If you find this valuable, don't forget to like, comment, and subscribe for more expert financial content. Part 1. Why getting the right amount matters? Let's start here. Life insurance is about protection, not profit. Too little coverage means your spouse or kids might not be able to stay in the family home. They might struggle to cover education or be forced to dip into savings earlier than expected. Too much coverage, on the other hand, can waste insurance and thousands of dollars over the years. That's money that could be invested into your business, your retirement, or your family experiences. The goal isn't as much insurance as possible. It's the right amount for your needs. That's where the formula comes in. Part 2, the simple formula. Here it is. Debts plus future obligations minus existing assets equals coverage needs. This is the foundation of calculating your life insurance needs. Let's break it down carefully. Step 1, debts. Start by listing your outstanding debts. This usually includes your mortgage, car loans, or lines of credit, credit cards or other personal debts, business loans you may be personally responsible for. Think of it this way. If you weren't here tomorrow, which debts would fall on your spouse or your estate? That's the number you start with. Step 2, future obligations. Next, look ahead. What future costs would you or your family face if you weren't around? This could include education for your children or grandchildren, ongoing living expenses for your spouse, retirement contributions that you would have made, even caring for aging parents. If that's something you're responsible for, this part often surprises people. Life insurance isn't just about today's bills. It's about the lifestyle your family would need for years. And step 3, existing assets. Finally, subtract what you already have in place. This includes savings, RSPs, TFSAs, or non-registered investments, other life insurance you already carry, rental income or other income streams your family could rely on. By subtracting these assets, you avoid overinsuring. Here's a quick example. Debts. $600,000 mortgage plus $40,000 car loan equals $640,000. Future obligations, $150,000 for kids, education, plus $500,000 for living costs equals $650,000. Existing assets, $200,000 RSPs plus $100,000 TFA equals $300,000. $990,000 coverage needed. So instead of guessing, this family knows they need roughly $1 million in life insurance. Part 3, real world scenarios. Let's walk through a few different Canadian examples. Scenario 1, young family with a mortgage. James and Emily are in their 30s. They have 2 young children at a $500,000 mortgage. James earns $120,000 per year. Emily works part-time while raising the kids. Using the formula, debts, $500,000 mortgage, future obligations, $200,000 for education, plus $400,000 for lifestyle expenses. Assets, $100,000 in savings and investments. Coverage needed equals $1 million. This ensures Emily could pay off the mortgage coverage, the kids' education, and still have funds for living expenses. Scenario 2, business owner with corporate assets. Michael, age 52, owns a construction company. He has a $300,000 mortgage and $2 million inside his corporation. He doesn't need to replace income for dependents. His kids are grown and independent. His main concern is the tax bill on its corporate shares when he passes away. The estimated estate tax is $600,000. He has $200,000 in personal savings. Coverage needed equals $400,000. This shows why business owners often need a very different type of coverage, less about income replacement, more about tax and succession planning. Scenario 3, retiree couple with strong investments. Susan and Paul are in their early 60s. Their mortgage is fully paid and they have $1.5 million in investments. The kids are financially independent. They don't need life insurance for income replacement, but they do want enough to cover financial or final expenses and potential estate taxes on their non-registered assets. They might only need $100,000 to $200,000 in coverage. This illustrates how your life insurance needs decline over time as debts shrink and assets grow. Scenario 4, high-income professional in their peak years. Sophie is 42, a lawyer earning $250,000 annually. She has a $700,000 mortgage and 2 children in private school. If she passes away, her family not only loses her income but also faces major lifestyle costs. Using the formula, debts $700,000, future obligations $400,000, education and living costs, assets $200,000 in investments, coverage equals $900,000. For someone like Sophie, the biggest risk isn't dying later in retirement, it's being underinsured during her peak earning and responsibility years. Part 4, term vs permanent coverage. Once you know your number, the next question is, what kind of life insurance should you buy? Term insurance, designed for temporary needs, affordable and flexible, ideal for protecting a mortgage, income, or kids' education. Example, 20-year, $1 million term policy might cost a 35-year-old parent only a few dollars a day. That protects or covers them during the most critical years. Permanent insurance lasts for your lifetime, builds cash value, best for estate planning, business succession, and tax strategies. Example, business owner with $5 million in corporate assets might use permanent insurance to cover the tax liability at death. This ensures the company passes on smoothly to the next generation. The combination approach, many affluent Canadians use a blend of term and permanent coverage. Term to cover temporary obligations, the mortgage, kids, and income. Permanent for long-term estate and wealth transfer planning. This gives protection today and flexibility for tomorrow. Part 5, common mistakes Canadians make. Relying only on work coverage. Employer insurance is usually 1 or 2 times salary, and it often ends when you retire or change jobs. That's not nearly enough. Guessing the number, picking $250,000 or $500,000 because it sounds right, leaves gaps. The formula gives you clarity. Not reviewing coverage, life changes, marriages, kids, new business ventures. Insurance should be updated every few years. Overinsuring, buying $2 million of coverage when you only need $800,000 just drains cash flow. Stick to the formula. Part 6, a smarter way to think about it. At the end of the day, life insurance is not about chasing the biggest number. It's about filling the gap between what your family will need and what they already have. Here are the key questions asked. If I weren't here tomorrow, what bills would my family face immediately? What long-term goals, like education or retirement, would still need funding? And what assets already exist that could cover part of the gap? Answer those, and you'll know exactly how much coverage to carry. No more, no less. Here's the bottom line. How much life insurance you need comes down to one clear formula: debts and future obligations minus existing assets. For some Canadians, that number is over $1 million. For others, it may be a fraction of that. The key is tailoring coverage to your situation so you're protected without overspending. If you'd like help running your own numbers or reviewing whether your current policies still make sense, book a time with me using the link in the description below. We'll walk through your personal situation and make sure your insurance strategy is clear, efficient, and built for your goals.